By the way, my grandma is thinking about buying Tesla.
She's still driving?
No, I'm talking about shares. What do you think about that? I mean, you have a Tesla.
I think the car is great, but I have no idea about the stock market. I really like this YouTube channel, Explain Me Something. I'm sure they have a video about Tesla.
Oh, let's check it out.
Welcome to this week's episode of Explain Me Something. Today, we're talking about Tesla. What's Tesla? Tesla was founded in 2003. They're an American electric vehicle and clean energy company based in Palo Alto, California. Their products can be organized into two categories. The electric vehicle segment with models ranging from $38,000 to $200,000, with after-sales servicing being part of this segment as well, and the energy generation and storage segment with solar panels, solar roofs, and the Tesla Powerwall. While this segment currently represents only 7% of total revenues, Tesla continues to believe that the energy segment will ultimately be as large as the vehicle business. Tesla operates in the global market, with its most important market being the United States, followed by China. It experienced a compounded annual growth rate of 44.6% since 2017. That's crazy. But now onto the question of how does Tesla make this wonderful car? Let's take a look at the value chain. An innovative R&D segment designs and develops cars. Procurement sources raw materials and scarce materials. Manufacturing plants are currently in Fremont and Shanghai, with current or planned expansion into Nevada, New York, Texas, and Berlin. Tesla has a unique marketing strategy with showrooms in inner cities, and all cars are sold by Tesla directly. Additionally, Tesla manages a network of superchargers and services all cars themselves through a network of service centers. Now, who are their customers? It comprises of the high-end luxury, the mid-price range, the green community, fast sports car enthusiasts, autopilots, Tesla followers, and of course, the die-hard Elon Musk fans. Customers, they're very, very happy. Tesla has the highest satisfaction rate among car manufacturers at a whopping 90%, and 80% of Tesla customers replace their Tesla with another. Within the electric vehicle market, Tesla has the largest share at 18%. But only 2.5% of all cars sold are electric vehicles. So when you put it into perspective, Tesla has a really big piece of a very small pie. So let's get to the part we've all been waiting for. What is going on with Tesla's stock price this year? Let's zoom in a little bit. Okay, so positive earnings and steady production. Okay, cool, a new battery. A profit for the fourth quarter in a row. There's a 5-for-1 stock split, and Tesla joins the S&P 500. So to me, the key takeaways seem to be that they're finally turning a profit, and they might actually have their first year of positive earnings. They've also solved the car delivery issue that they've been notoriously famous for, and now they have record deliveries. I mean, it's all good stuff, but it seems like I'm missing something here. Does all of this justify the high stock price? What do you guys think? Is this company overvalued or undervalued right now? Can someone help me out and leave a comment below? Thanks for watching my channel. Click the like button and subscribe below. See you all next week.
Oh, that's interesting.
We've been waiting since 10 minutes now. Nico and Alina are almost always late. I miss Indian punctuality. I know. Look, they're coming now.
Hey guys, how's it going?
Great! We were just talking about my grandma, how she's interested in investing in Tesla.
Nice! I actually just got a notification from my favorite report about Tesla. We can watch it together.
Yeah.
Welcome to Breaking News TV East Switzerland. Goldman Sachs analyst Mark Delaney announced on December 2nd that the target price for Tesla stock is increased from $455 to $780. This historic move is in line with an overall trend in analysts' average target prices that have increased by 25% over the past 3 months. With this new target price, Delaney now values Tesla at $740 billion, just $70 billion lower than Facebook's evaluation. Delaney points in his explanation of the target price to Tesla's high operating margin, vertically integrated strategy, and favorable developments in solar market evaluations. After Goldman's call, Tesla stock took up 3% in pre-market trading. However, other analysts have been more critical. Among them Ryan Brinkman from JP Morgan, who set the target price for Tesla stock to $75 and gives a clear sell recommendation. Brinkman sees Tesla's current stock development as a, quote, lofty valuation with high investor expectations and high execution risk. Overall, Analysts give a wide range of target prices, averaging at $375. The analyst's recommendation is almost balanced between sell, hold, and buy, with some news outlets referring to slight tendencies towards buy.
Analyst opinions are important but not to brag. I just took a class on multiples valuation and I chose Tesla as the company to value. Let me show you the valuation that I have.
What's a multiples valuation?
Let's start with the basics. I will take you through a simple analogy of, say, Alina, your grandmother buying chocolates at a grocery store. There's a newly launched flavor of Toblerone dark chocolate. Grandma has heard all about it, but she is not sure if she should spend $7 for 200 grams, so she decides to estimate a fair price by comparing it to other chocolates. But what should she compare with? The best way would be to group the chocolates based on the content of cocoa. This results in 3 categories, namely white chocolate, milk chocolate, and dark chocolate. Now she can select the appropriate category, which is dark chocolate. Since the chocolates vary in weight, a comparison is difficult. Therefore, she divides the price by the weight. Comparing the results, she realizes that the Toblerone dark chocolate should cost around 3 cents per gram. She then multiplies this ratio by the weight of the Toblerone bar and arrives at her estimate of $6.6. Compared with the marked price of $7, that's definitely overpriced, and Grandma sticks to Lindt. In a similar approach, we used multiples to value Tesla by first finding comparable companies. Since Tesla has a unique product offering and business model, it is hard to find similar companies. We compared it to 5 categories that characterize Tesla, namely disruptive technology, clean technology, auto tech innovation, luxury automakers, and high growth automakers. For each category, we compared Tesla's performance to the operational benchmarks net sales CAGR, adjusted EBITDA CAGR, adjusted EBITDA margin, cash flow from operating activities to sales ratio, and cash conversion cycle. We next look at industry-specific benchmarking ratios. For the automotive industry, we look at inventory turnover ratio and average ROE, while for the tech industry, we look at current ratio and cash ratio. For both industries, debt on equity ratio is relevant. On analyzing the results, we find that Tesla is closest to tech and high-growth automakers. Next, we move on to the valuation. We use the price on sales, price on free cash flows, and price earnings ratio and multiplied each metric by the corresponding historic values of Tesla. Similarly, we apply the EV on EBITDA ratio to the expected performance of Tesla. This step is equivalent to calculating the price per gram of chocolate and multiplying it by the total weight. We then arrived at the per share value by dividing the enterprise value by the total number of outstanding shares. Depending on the multiple and the industry compared to, we are faced with a wide range of prices, which also highlights the flaws of the multiples approach. As Tesla has only recently started to generate profits and these are expected to further grow, we use the price on sales multiples. And since Apple, Amazon, and BYD are closest peers based on the benchmarks or the business model, we decided to use an unweighted average of these 3 multiples, which results in an estimate of $136 per share. Definitely overpriced.
Okay, so with the multiples valuation, you're comparing Tesla with Amazon today. But Amazon also had low to negative earnings and reinvested everything until they became profitable. So doesn't this justify Tesla's market price?
Not so sure. When Tesla reached the market capitalization of $300 billion in July, it had 1/3 the revenues of Amazon and 1/5 of Apple, as compared to when they reached the same market capitalization of $300 billion.
Oh. So is comparing Tesla with other companies the only way to find the fair price?
Let's pick up this hitchhiker here. Maybe he knows more about valuating Tesla.
Yes, I do. I recently quit my job in investment banking because I was so burned out. What you have to do is a DCF.
What is a DCF? Explain it to us.
Yeah, I can quickly show it to you. I worked in Tesla valuation recently and I remember all the figures by heart. So imagine that you have to price a cow.
First, you would estimate the milk it will produce and also the food and time that you will have to invest, right? All this generates or consumes cash. If then you sum up all the net cash generated, you would get the maximum price to pay for the cow. Let's try to do the same with Tesla. First, we will estimate the revenues, second the operating costs, third the investment needs, and finally we will calculate the future cash flows and the share price. Tesla, as you may know, has 3 different product lines. To forecast revenues for each line, the best is to look at past trends, future demand in the market, and forecasts of experts. Analyzing historical trends, I can tell you that the service line seems to always account for 10% of the automotive segment. The energy segment, despite the high expectations, is not really taking off, as you can see. I can tell that the electric vehicles market has a promising outlook. Its market share is forecasted to be 6 times higher in only 1 decade. Equity reports are also a valuable source of information. In this sense, when I was in Deutsche Bank, we forecasted that by 2025, Tesla will reach the 2 million figure of units delivered. Therefore, I would say that Tesla will double its sales in 5 years, and it will be mainly fueled by the growth of the automotive segment. As a second step, we have to see how much profit would be left after expenses. Production costs as a percentage of revenues are expected to decrease for all product lines. This will be mainly driven by gains in economies of scale and know-how. Going to the operating expenses necessary to obtain the EBIT, we can also expect a significant decrease as percentage of revenues, even more than with the production cost. The reason is simple. For each unit sold increase, Tesla doesn't need extra administrative staff in the headquarters. Does it make sense for you? The next step is about estimating how much will Tesla need to invest in facilities. Tesla needs lots of machinery to manufacture its products, and the core of this infrastructure are the famous gigafactories that you can find in the map. As you can see in the table, most of them are either under construction or in expansion, so important investment in capex can be anticipated. The expected capacity is planned to reach 2.2 million cars yearly, slightly above the 2 million that we forecasted by 2025. Therefore, the demand of investments will continue, but at a slower pace. Next, let's calculate the investments in working capital. For Tesla, there is no sale that doesn't start with the supplier providing the materials. These materials are processed, workers are paid, and 60 days after the delivery, Tesla suppliers get paid too. 3 days later, the product is delivered to the customer, and finally, 17 days after, the customer pays for the product. The issue then is that between paying the suppliers, workers, etc., and receiving the cash from the customer, at least 20 days have passed, meaning that Tesla needs to anticipate all this cash. In the past, Tesla has become more efficient, and as a percentage of revenues, is needing less financing. I would argue that this downward trend will continue and will produce this graph until 2025. Now we can already calculate the cash flow that Tesla will generate in 2021. We start from the revenues, then we subtract the production and operating expenses. After that we calculate the operating cash flow, and finally we subtract the capital expenditures to obtain a free cash flow to the firm of almost 500 million. If we repeat the same process, we would get the result of this graph. Beyond 2025, though, it becomes too uncertain to forecast everything, and the best is to assume a stable percentage growth rate at, let's say, 5%. The problem now is that this future cash is uncertain. Look, if things go well, banks will get the loans back, and the leftovers will go to the investors. However, if things go bad, only banks will partially recover some of the loans. That's why banks usually require lower interest rates, because the risk is lower for them. In that sense, a company like Tesla, that is still growing and barely generating profits, is very common to be only financed with equity. However, with time it's normal to assume that the percentage of debt would be somewhere closer to 20%. To bring all this cash to today then, we need to start from the terminal value in 2026. By applying this formula, we get the terminal value in 2025. And if then we bring all the yearly values to 2020 by discounting them with the cost of capital, we get that Tesla will generate the equivalent of $196 billion of today. Tesla then has $1.5 billion in cash and around $196 billion to be generated in the future. The final step consists of distributing this money. Banks and external investors of Tesla subsidiaries get the money back before shareholders do. With that, there is almost $169 billion left for Tesla shareholders. This needs to be equally distributed to the 948 million shares, meaning that each share would perceive a value of around $177.5 US.
So it seems like you can value Tesla using multiples and DCF. But with both methods, the share price is overvalued. Your grandma shouldn't buy shares.
I will definitely tell her that. She probably should focus on the Christmas cookies. They are also overrated.